Ladies and gentlemen, please put your hands together for Mr. John Reed, Market Strategist, Europe and Asia, World Gold Council.
I wish I still looked like that picture up there. Unfortunately, it's now nearly 37 years of experience. Time passes in this business, as you all know. So look, I've got a presentation I'm going to talk about which explains why gold should be part of investors' portfolios. I know this is a passives conference. Fortunately, there are lots of gold exchange-traded funds in existence. The World Gold Council actually was responsible for creating the first of the commodity-backed exchange-traded funds, so we have a long history in passives. I'm not going to run through too much detail in terms of who the World Gold Council is. I hope we're well known in India. We're owned by a number of gold mining companies. We're responsible for developing the gold market globally. We have offices around the world, including here in Mumbai. We've done a number of things. I mentioned the ETFs, lots of other things we're doing, increasingly in the field of ESG now, as that is so important. There's lots of information if you're interested in what we do. I think it's useful to think about the gold market in general before we get into the details of why it should be part of your portfolio. It's an emerging market story, and that's one of the reasons why gold demand has grown strongly, because of the strength of the economies in emerging markets, particularly in China, Indian subcontinent. The developed market demand for gold has declined as a proportion overall. So by being in gold, you're exposed to the rapidly growing markets. Gold has a variety of demands, applications as well. We think perhaps in India most about jewelry because it's such a prominent component, but globally it's only about 37% of demand. 7% of it goes into technology, so every electronic device that we have in our hands requires gold to work. So those two bits are driven by economic activity and growth. On the other side, we've got the investments, which is about 40%, and central banks, which are about 18%. So that's very much gold as an investment asset class, as a store of value, driven by diversification and uncertainty. We've just published our recent gold demand trends report. It's one of the things that we do each quarter. I'm not going to run through it in any detail, but if you're interested in what's happening in the gold market, it stands as a very good summary of what's been going on. Two themes I would bring out that have been very important in gold in the last 12 months. Central banks buying a lot more gold than they have done ever. The second theme as well is the recovery that we're seeing from China after they've come out of COVID. But what is the strategic case for gold? Why should gold be in portfolios? People think gold does well during times of inflation and during times of crisis, and that's true. But it's also done well over the longer term as well. We produce these charts in pretty much every market that we go to, different time frames, sometimes because of the data availability, but the story is very similar. Gold has been a contributor of returns to portfolios that have been in line with or better than other classes, whether it's over 5 years, whether it's over 20 years, or whether it's since 1971. So that's a really important characteristic. Probably a bigger characteristic, or a more important characteristic, is gold's diversification benefits. Gold's uncorrelated to equities. And since equities make up most of people's portfolios, that diversification or lack of correlation is really important. But there's more to it than that. On average, it's uncorrelated, but when equities are having a bad time, when they're falling by more than 2 standard deviations in a week, that correlation turns slightly negative. And when it falls by more than 3 standard deviations, that correlation turns very negative. So now you're negatively correlated to a falling equity market. Is exactly what you want. So a combination of returns, attractive correlation characteristics lead gold to play a decent role in portfolios. It's also a liquid market as well. As you can see here, more liquid than Indian government bonds or the dollar-rupee exchange rate, roughly as liquid in terms of billions a day as the Indian equity market. Of course, nothing is as liquid as the US Treasury market. There have been periods of relatively low or relatively poor performance of gold. That is something to bear in mind. This is not an asset that you want to be flipping out of on a year-by-year basis. It works better if you have it in your portfolio for the long term, largely because it tends to protect you against unforeseen events like COVID, like the Russia invasion of Ukraine, like the incipient banking crisis in the US. It's got a reputation of doing well during periods of high inflation, which is well deserved. Gold performs better during higher CPI. But the work that we've done suggests that gold actually is more correlated to US money supply growth than it is to inflation. And the good thing about that is that money supply growth tends to take place before inflation takes off. So you're protected against coming inflation rather than trying to chase assets higher when inflation is here. So what does this do to your portfolio? Having an appropriate amount of gold in a portfolio increases the risk-adjusted return of that portfolio. So we've taken a hypothetical Indian portfolio. Risk-adjusted returns of that portfolio shown on the left-hand side. It's a typical portfolio with equities, fixed income, and a little bit of alternates. And then we've added gold to that portfolio, reducing everything else proportionally. And you can see that within a range of up to 10% allocation to gold, increasing the weight of gold increases the risk-adjusted return of that portfolio. It also reduces the drawdowns. It reduces the volatility of the portfolio. All of these characteristics extremely important to investors who are looking for stability and returns within a portfolio. If you're looking at it from a value at risk perspective, two portfolios, one with gold, one without, adding gold to the portfolio, in this case about 10%, increases the diversification benefits of that portfolio and reduces your total VAR. Looking at drawdowns, if you look at the portfolio, it's on the left-hand side, and I apologize for the colors because they're very similar, but what you can see is the pink lines are the drawdowns experienced by a portfolio without that 10% allocation to gold, and the slightly goldy lines with. Another way of looking at that is to show the benefits that you have in terms of reducing your drawdowns if you had gold in your portfolio. And you can see on average, it's reduced drawdowns, and there's been very few times where gold has contributed negative drawdowns to a portfolio. So we look at a lot of portfolios around the world. We draw up efficient frontiers with gold, without gold, various ranges of volatility and returns. It's interesting to me because I give these presentations in different markets around the world throughout the course of the year. Every market that we've looked at and virtually every portfolio that we've looked at will gain a benefit from having gold in that portfolio over the last 5, 10, 20 years. Quite how much gold you allocate to a portfolio depends what's in the portfolio. The more equity-like risk, the higher the target allocation to gold has been. The only portfolios that we've found that don't benefit from gold are so-called money market funds, because all they are designed to do is to return a yield very similar to treasury bills. But other than that, including gold in a portfolio, if it's a fixed income heavy portfolio, could be as low as 2 or 3% allocation. If it's a very heavy equity portfolio, it could be as high as 15%. We produce a lot of research on gold. The research team at the World Gold Council writes pieces every day, every week. We're very active on social media. We've got a great website called Gold Hub, which has all our research, our data, and our tools available for free. If you're interested in gold, if you're interested in the merits of gold in a portfolio, I'd encourage you to sign up. And if you have any questions, please be in contact with us. We'll go from there. Thank you very much.